What's going on? Chris here. So we got a lot of things here, but basically it's the Apex products, and we organized it in such a way to where we took out the misleading factor. The misleading factor is the account amount, and thinking that that is the real value of the account. It's none of them are the real value of that account. So it is intellectually disingenuous to use that as the leading point of making a decision, because it's not it's actually it's a misleading factor. What is the real factor is the trailing threshold that the monthly payment buys. The highest account has the highest trailing threshold, and then there's a cost per month associated with it. And let's see, 25K is 147,000 a month for 1,500. Yeah, so it's this one's wrong. This one's 147. So we've decided to take out the misleading data, and this is kind of not really relevant here, but for the most part, we've isolated the relevant data, which is the cost per month and the trailing drawdown, the benefit you buy. And then we made a ratio based upon the efficiency. So if the discounts are the ones that show increasing efficiency, the thing that it tells us is that the more discount we get, the lower the number gets. We see three decimal numbers. In order to get to a number, we got to move it once, twice, three times, or at least twice before we can get to 0.7. And we got 008, 006. So the more discount we get, the smaller number of a ratio we get, and that shows increasing efficiency. So we have an anchor as to what would be increasingly more efficient. It's the smaller the number, the better. So we've isolated that this is the $150,000 account, that it's the most efficient in terms of value of cost per month and its trailing drawdown amount. And then the second one is the 50 grand. This is 25 and this is 50. This is 75. This is 100, 150, 250, 300. And it's saying that basically first place goes to the 150, and second place 0.668 versus 0.668, 0.68, 0.69 were the ones in competition, but the 50 grand is second place. And it just continues consistently, whether it's 80 grand or 80% off or 90% off, that the ones that were in first or second are consistently in first and second. So that kind of brings us to the strategy. Like, how do we approach the Apex products? It basically narrows it down to two products. So we could hide the inefficient products right here, hide them, and then we could release the value amount, even though they don't really matter. So what's weird about these accounts, and why I removed it, is because all the accounts are kind of seen as equal. The only thing that makes them not equal is the trailing drawdown. So how it works is that once you pass the evaluation, then once the evaluation is passed, you got to move into profit the account, the amount of the trailing threshold, in order for you to actually start building the account from zero. So in actuality, you are literally building each account from zero once you pass the trailing drawdown threshold in a live account. And whether that counts $300,000 or 150, you actually start with zero once you pass the trailing threshold. And then once you pass the trailing threshold, that's when it actually builds real value in the account. It doesn't start at 300 grand. That's there just to fool you. So that's kind of just the upsetting part about the product placement or display, is that it's intellectually dishonest. Even though they are a well-known company and they try to help you make money, essentially, but the advertisement is a little dishonest. So then now we're into the strategy portion. We identified the most efficient account and the second most efficient account, and we got two types of trailing drawdowns. We can get a double the trailing drawdown, basically. 2,500 is the primary one, and it's also the cheapest. It's about maybe roughly half as expensive. Yeah, it's really close to just half as expensive. So there's two purposes, two ways you can grow the accounts. One is vertical growth, and it's a little bit of a low and slow. The purpose and intention of just the vertical growth is that you want to grow from past the trailing threshold to where the account is actually closer, in increasing in value, getting closer to what it should be valued at, which is 150 grand or 50 grand. But every account starts at zero, so the whole goal of the account is to grow it past zero and grow it forever. So vertical is about growing it in the account and having it accrue value. You either eat your seed or you invest it, and in this case, it would be to invest it and keeping it to growing on the inside of the account without taking withdrawal. And the $150,000 account actually has the highest chance of success in terms of growth because it has a higher trailing threshold drawdown, and this is unrealized trail. So that makes a big impact on just how it's grown, how much forgiveness you're given. But in terms of strategy, the low and slow best value for the large version for like a long-term account would be the 150,000. Like the vertical growth goes to the $150,000. You could do it in batches where you buy during a promotion a bunch of accounts like 6 or 10. Getting around 20 it gets really expensive on like the lifestyle per month. Like 20 accounts, once they get to a live account, it's around $1,600. And then if you're to get 40, it gets really expensive, like $2,400 roughly per month. So it makes sense that you would do 10 or less of the 150 grand accounts, and the goal is to grow it over a long period of time to where you can use it as a base, like they're safe, and to grow it to 100 grand, 150 grand, so to where you can increase the percent per risk per trade you take. Now, the smaller version, I view it as more for horizontal. So this one's for vertical growth, I feel like, because it's more expensive. So it makes sense that you would want to invest a whole lot into them. Now the ones, like, they're both kind of equal once they hit the trailing threshold in the live account. They're basically both starting from zero. But the thing is, with the smaller account, you have a higher risk of defaulting, or like they call it blowing the account. You have a higher risk of blowing the account and you would have to pay $80 to reset. So it makes sense that you would want to go first for the higher version because it's harder to blow that account, and it's less of a risk. It's more hardy. Now the smaller one, if you have more skill, it makes sense to go for the cheaper one. But keep in mind that it has a higher risk of blowing the account. But when it's cheaper, you're able to have a high volume of amount of these things. And there's two strategies. You can stagger the number of accounts bought to take it in to grow, or you could buy it in batches. For horizontal growth, volume of number of accounts, and comparatively, percent per risk per trade is totally different compared to the number of accounts. The number of accounts allows you to multiply your contracts exponentially. It's a lot faster. But the bad thing about this is the con. Even though it's cheap, even if you were to get in on a promotion, once they become a live account, each one of those accounts to maintain costs $80, and that's where I got. If you got 20 accounts, it'd be $1,600. If you got 40, it would be $2,400 per month. That's a lot of money. And my idea is that you would use the vertical growth as like a base, and that would be pretty much the income to feed the horizontal accounts. Now, I do think that there is a strategy on when it's more beneficial for each account. So I'm kind of tapping into the Eurodollar futures curve. We go here. I'm going to pull up a picture. We go to the cent. And then we can look at the Eurodollar futures picture. So ideally, to operate a huge volume batch or stagger of those smaller trailing drawdown accounts, it makes sense to farm the cheaper accounts on the green zone. There's less volatility. There's a better chance for higher quality price action and less volatility, less of a chance of it failing. So we're doing it from the perspective of the highest chance for high success on the higher risk account for that passing. So it makes sense that with a larger trailing drawdown that you would be able to take on a little bit more volatility that way. And then with the smaller one, you would have to do it when it's less volatile. So you'd have to do it when it's in the green zone of the Eurodollar futures curve cycle. The cycle lasts 22 years. We got the cycle starting in 1991, ending in 2013, starting in 2013 for the start of the green zone. Each green zone of each cycle of the 22-year cycle lasts for 5 to 6 years. So 2013 plus 5 or 6 plus just 2018, 2019, which things started to invert on the treasuries around that time. So it's a really interesting kind of cycle. But I think if I were to put a strategy with vertical growth and horizontal growth, I would want to do the horizontal growth during the green periods, and then vertical growth during the fragility periods, because it'll be less dependent on volume and more dependent on just growth of what you have. And then out of the growth of what you have, you can take a percentage of that and then put it into new accounts to grow vertically in that area. And I don't know, I like the pay yourself 10%. So you could do a match where you pay yourself 10% on withdrawal, and then 10% goes to growth for more accounts of vertical growth. And then maybe 10% goes to maintenance, or it could be just flat 20 split, and whatever profits you get from your 10% could be reinvested. That's kind of just the option there. But I think that would be the best strategy I would do, and then When it comes time for the green zone, the focus is totally on trying to get the largest amount at the best deal that can pass and that you could sustain. So you would have to do it based upon what you could afford per month on the number of accounts. So you would take the promotion price, or you would have to do the flat fee of $80 per account, and then see at what number would it be too much of a squeeze on the lifestyle of being able to get by month to month and having a good enough cushion. You could do 1/3 of the total income per month, or you could do 2/3, a little more aggressive. But that's kind of just how I would weigh it in terms of like the batches. But during the whole green period, it could be batch growth of just these accounts to where now you pushed all of these cheap accounts past the threshold of the break even trailing drawdown, and you've grown it enough to where it's got a little bit of a cushion to now where the trailing threshold is almost equal, or if not non-existent, between the accounts, and you've just now multiplied your accounts and the amount of income you could bring in per account. And that's kind of just a wild idea, is that some could grow by percentage per risk, and then some can grow just by the fact that you have multiple accounts, and now you have a multiplicative factor. You have two types of leverages. One's a multiplicative factor of number of accounts and then profit per account, and then the other one is a multiplicative factor based upon percentage per risk and the amount of reward that would come with those risk to reward trades, and increasing the amount of risk that you can take per trade, allowing you to buy bigger size in that kind of multiplicative factor. But the fact that you could grow in two forms of leverage is quite amazing, to where the growth could be quantum, exponential. To me, quantum means like more than one leverage, being exponential in more than one way. Exponential is just a multiplicative factor that's able to compound, but when it's on two levels, like, I think that adds just a degree of just even like more amazing compounding, but it's just labeled more fancy. But that's my video on my strategy on how I would approach the cheapest, like biggest trailing drawdown option, the most efficient one, and then the second, the most efficient with the largest trailing drawdown, that's a little more in the more expensive, and then the cheapest one, that's the second most efficient, but it takes on a little bit more risk because it's half the trailing drawdown, but it's also half the price. And obviously there's time periods of like promotional periods, and I think buying it during the times of promotion is like a really wise idea. And it looks like there's going to be time periods to where that makes the most sense. So for example, we're in the fragility zone. We're in 2023. It makes the most sense to go after staggering in, whether it's batches or just during promotional periods where you could build the longer term, the higher trailing drawdown threshold, and getting it to where the recurring month it's able to go beyond the recurring month. So this most recent promotion for Apex is just 90% off for the first first month. But if you could get it for every month, then it allows you to have more access to more of a batch for your lifestyle. And that's kind of what you want. You want to have, so if the $150,000 account, if it's 80% off, you want to see if you can get it for multiple months. If not, you're going to have to do probably half the size, or if not, a fourth of the size you would normally do comparatively, because if you were to grow from a promotion, you would need a couple months for it to either pass or grow past that trailing threshold break-even point, and to be able to withstand some of the volatility and the swings. But and learning your system. But that's, in a nutshell, my strategy with Apex. In conclusion, I think it's a little disingenuous that they put these big numbers above each account, because really you're actually building the account from zero, and you're paying for the trailing drawdown threshold. And once every account has passed the evaluation, they're rebilled at a flat rate of $80 per month, and all the accounts actually start at zero. But you either are able to have a larger trailing drawdown threshold, and that shows in the break even as well. And every account starts from zero, and they just then start beginning to grow after passing that break even trailing drawdown threshold. So thanks for watching. Hopefully you learned about maybe the first or second efficient account number. The one con, though, I would have to say is that these cheaper accounts, you have access to a larger number, but once you pass them, the maintenance is a lot higher. Just because if you have 20, I think I've mentioned this before, but if you have 20 accounts, the rebill is 20 times 80, most approximately. Approximately, it's that. So around $1,600. So it can add up in terms of, and that's kind of why I think the vertical growth, if you're able to withstand it within your lifestyle, and just the amount you're able to withdraw to sustain the growth, then you could theoretically use some of that growth as a base to fund and finance the horizontal funding for growing the volume of accounts. But I would say definitely that each account has its place and purpose, and I think it makes sense to grow vertically first, and at a appropriate to your lifestyle in terms of the number of accounts. And in the fragility period, where there's more volatility and chances of fake outs, to really kind of take it easy until things get a little bit more easier in terms of easy liquidity and upward movement. So that's pretty much it. Thanks for watching. See you in the next video.